Lynch with AmeriFirst Financial. Happy Monday morning. It's time for your Monday morning mortgage update for the week of June the 6th. I hope everybody had a fantastic weekend. Gail and I had a great weekend. Cool weather, rain. We know it's the last cool piece of weather before it heats up in Northern California. And it's supposed to be up over 100 degrees by the end of the week. So it's coming. We all know it is, but really what a nice weekend. Gail and I went to a couple of events this weekend. On Friday, we had a great event with the Shasta Association of Realtors, cornhole game, hoedown, great ribs, and just connected with a lot of our friends. And then on Saturday night, we went to a fundraiser for the Friends of Whiskeytown and the Make-A-Wish Foundation. Had a great event and good dancing. We haven't danced in so long, but just enjoyed our time. And again, raised money for a great cause, Friends of Whiskeytown. They're doing a lot of great work out at Whiskeytown Lake. So let's talk about what happened last week and what's going to happen this week and how that's going to affect the market. So last week, really we saw a over 50 bips or basis point sell-off in the market, and that offset the week before we had a 50 basis point improvement in the market. So what does that mean? It means that we have a ton of volatility right now. The market's up, the market's down, and it just means that we've really been in a very cautious floating position to a locking position. The data was all over the place last week. Manufacturing actually was improved, and a lot of other data showed the economy is actually expanding and growing. That's bad for bonds and mortgage rates and good for our economy. Wage inflation is way up. Workers are still having trouble finding employees, and wages are up. Now, that contradicts the low unemployment rate, but there's 10 to 11 million jobs that are still unfilled, and people just aren't looking for work. So it's a real problem with employers, and you get a lot of misinformation out there. Auto sales were down, and is that a sign that maybe people aren't buying more expensive items because this inflation is really hitting them in the pocketbook? Yeah, it probably is. So what are we looking at this week? What are our three things? Inflation. We're looking at central banks, and we're looking at a treasury dump. So inflation we know is a kryptonite of bonds. It's the worst thing we can see, for which basically means interest rates, because mortgage-backed securities are traded in that bond market. And if you think about it this way, if you have $1 million in bonds and you're getting a 4% rate or yield on those bonds, and inflation's 1%, you're getting a 3% rate of return. If you have that same 4% yield on those bonds, and inflation is now 3%, you're getting a 1% rate of return. So you're not getting the return. So what happens is those bond yields improve or are increased by U.S. government that's selling bonds, companies are selling bonds. That's increased so that investors are enticed to invest in bonds, which is a safer investment than the stock market, and that increases their rate of return as inflation goes up, and that causes rates to go up. Pretty straightforward. So one of the things that the Fed's been doing is raising their Fed fund rate so that they can offset inflation. It's the primary way that the Fed can fight inflation, and we know they're doing it. They're going to do it in their meeting next week by 0.5 point. That's what everybody expects. They did it last meeting by 0.5 point, and the meeting before by that 1/4 point. So if they follow through and raise the federal fund rate at 0.5 point, that means that in the last 3 or 4 months, they've raised the Fed fund rate 1.25%. Now, keep in mind that Fed fund rate affects equity line rates, auto loan rates, it affects credit card rates, and it affects the interest that businesses are charged to borrow money to run their businesses. So those costs go up, and those costs are passed down to us, the consumer. And when we are charged more, we buy less. That slows the economy down. That brings the cost down, brings inflation down. It's just a tool that the Fed uses. So CPI, the big report coming out this week, the Consumer Price Index, a key measure of inflation, is coming out Friday. Really going to pay a lot of attention to that. What's it going to do? Guess what? It's going to go up. We know it's going to go up. So let me show you an interesting comparison on the CPI. Get rid of my picture there. This is a 12-month chart on consumer price index. Now, this goes back to 2002, but really what it's showing is what inflation has done in the last 24 months. It's gone up every single month in the last 24 months since March 2020. And this is an overall, all items combined, showing you what inflation has done. Now, we can see these gray areas are the last two recessions we've had. We had a small recession in January of 2020, and of course the big housing crisis recession back in 2008, 9, and 10. But what we can see is that inflation is just going up. If we put food as a comparison, look what food's done. That's the blue mark. It's actually gone up drastically. We can look at gasoline. Guess what gasoline's done? Huge spikes to the cost of gas. What's energy done? Energy has gone up, right? So we know that turquoise colors energy. We can look at food at home, and you can just play with a chart like this. You can see that everything is just up, right? Everything's up, but the bottom line is you're going to hear a lot of media information out there that says, inflation's coming down. It's not coming down. It's just maybe not going up as high as it did, but it's still going up. It's going up every single month, and we expect it maybe to peak in the fall. And if it peaks and starts coming down, we expect some improvement to the interest rates in the fourth quarter of this year. What does that also mean? It means we're going to go into a recession. I've been talking about it, another 6 to 18 months. Some experts think that we're probably going to hit that inflation area in some time in 2023. So what is the second thing we're looking at? Central banks. So the ECB, the European Central Bank, like our Fed, is meeting this week. And are they going to raise their Fed rate or their equivalent of a Fed rate? They haven't done this yet. So inflation in European countries is out of control. It's higher than ours, at least our Fed, even though they messed up not dealing with inflation last year, at least they're doing something. And this is really telling if the ECB is going to actually make some monetary changes to try to fight inflation by raising their equivalent of the Fed fund. But what's this mean? It means that they're having a tough time, and with the problems they're having with Russia and Ukraine, it's even adding more problems to that, and they have to deal with this. What it also means is that our bond markets are very enticing to foreign investors right now. So we expect more money to be flowing into our bond market because at least we're doing something, and that could be good for rates coming down the pike if we see more investments in our bond market. So we'll be watching what the ECB does this week. And the third and final thing is a Treasury. So the U.S. Treasury auctions off notes and bonds to raise money, and they're having a couple Treasury sales. They do this every month this week, and Thursday's a big day. And if there's an appetite for those treasuries, if there's an appetite to buy the safer money, not invest in the stock market, but buy the safer money in the bond market, that actually could be an improvement to mortgage rates. So what are we doing this week? We're cautiously floating, really leading up into Thursday, seeing if we have any type of an appetite for that Treasury bond sale. If we do, we could see rates improve, but then Friday we could see rates get worse because inflation is going to be high. We know it's going to be higher than it is now. Another chart I want to show you is really what's happening in the bond market. So this is, I've shown you this many times, is trading the mortgage-backed securities in the bond market, and it really shows since the middle of April, we've been in this flat trading line. And so when we see a downward trend here, that means rates are going up. But look at what's happening here. We just see this real flat trading line. A lot of volatility, but rates really have stayed about the same in a general range for the last month and a half. What's going to happen in the future? We probably expect these rates to go up because the Federal Reserve is going to get out of reinvesting in the bond market. We'll talk about that in a few weeks. But just show you some charts, a lot of volatility. So we expect really to cautiously float into Thursday and probably move into a locking position on Friday. If you know of anybody that needs any input or advice on mortgage rates, please let me know. If you have any insight or questions, let me know. If you know somebody that can benefit from this, please forward it to them. Have a great, productive week, and we'll talk to you next week. Bye-bye.